Welcome back to the Deep Dive from TalkTickers. We break down earnings calls so you don't have to. Today, we're getting into the Allianz Group's first quarter 2025 results. And well, it looks like they had a very good start to the year. Our goal here is to unpack the key numbers, the insights, and really help you grasp the crucial takeaways quickly.
Absolutely. And if you just look at the headline figures, that strength is pretty clear right away. Total business volume hit a record, $54 billion. That's up almost 12%.
Wow, 12%.
Yeah, and the interesting thing is it wasn't just one area carrying the weight. Every segment contributed to that growth.
And that broad-based momentum, I assume, flowed right down to profit.
Exactly. Operating profit also hit a record level, $4.2 billion. Again, you see contributions from all the different parts of the business. Shareholder core net income came in at $2.6 billion, which they described as a strong level.
Okay, but wasn't there a bit of a disconnect? Why didn't that huge operating profit growth fully show up in the core net income growth?
Right. Good question. They pointed to two specific things this quarter. First, higher restructuring costs compared to last year. And second, an exceptional tax item. This tax thing is tied directly to their decision to sell stakes in those badged joint ventures.
Ah, okay. So that tax hit is a one-off, basically. Mm-hmm. Did they say what it looked like without that?
They did. If you adjust just for that tax effect, the core EPS is actually up a healthy 7%. And they made a point of saying that's right in line with what they'd guided the market towards. So the underlying engine seems strong.
Got it. And what about the balance sheet strength? Solvency.
Still very robust, holding steady at 208%. And that's really underpinned by very strong operating capital generation, the capital they make just from running the business.
How strong are we talking?
6 percentage points post-tax in the quarter alone.
6 points. It's huge.
It is. Strong enough that it completely offset the money going out for the regular dividend accrual and the share buyback program. Just the buyback chewed up 4.4 percentage points of solvency impact. So you can see how much capital the business is throwing off.
So basically, they're generating capital faster than they're returning it right now, even with the big buyback.
Pretty much. Yeah. And that puts them, as they said, squarely on track. They're confident this Q1 performance sets them up well for their 2025 goals and the midterm targets. They reaffirmed the full year outlook too. $16 billion operating profit, plus or minus $1 billion. They seem confident it's resilient.
Okay, so record start, strong capital generation, guidance confirmed. Sounds like solid execution. Let's dig into the segments then. Where did that strength come from?
Starting with P&C, Property and Casualty, they called it a very strong quarter. Record operating profit there too, $2.2 billion.
That's right. And they put it down to two main things, really earning the growth from their pricing and volume efforts and a very good combined ratio. Came in at 91.8%. And just a reminder, lower is better for combined ratio, right? Measures claims and expenses against premiums.
Exactly. So 91.8 is definitely a strong number.
You mentioned growth. How much was that?
About 7% internal growth across P&C. They broke it down roughly. 5% from price increases, 2% from volume, like new business.
Okay. And any difference between retail and commercial lines?
Yeah. They highlighted that the price and volume effects were stronger on the retail side, think personal auto. On the commercial side, the pricing momentum is slowing down, which, frankly, they said they expected. It matches what we're seeing elsewhere.
So less pricing power in commercial.
It's becoming more nuanced. They gave examples like motor line, seeing the highest level of rate discipline, getting those price hikes through, whereas for large corporate clients, pricing is moving more towards flat rates now.
So how are they underwriting in that environment, being selective?
Seems like it. They mentioned double-digit growth in new motor business volume over in Germany, where they must see opportunity. But then being more disciplined, maybe writing less in places like the UK or certain specific lines within AGCS, their big corporate insurance unit.
Okay, back to that combined ratio, 91.8%. What's really striking is how it compares to last year.
Right. It was actually slightly better than Q1 last year, which was 91.4%.
Even
though this quarter got hit much harder by natural catastrophes, Nat Cats cost them 2.1% of premiums this time versus only 0.4% last year.
So the underlying profitability improved quite a bit to offset those bigger cat losses.
Exactly. That's impressive.
And was this broad-based within P&C?
Seems so. They emphasized the breadth of performance. Said many of their operating entities delivered combined ratios in the 80s or low 90s, even with that higher cat load. Both retail, which they said is improving strongly from past actions, and commercial contributed. Commercial profitability is still attractive, though the reported number dipped a bit this quarter, mainly because of those cats and some discounting effects on reserves.
And our cost savings helping too.
Definitely. They mentioned the productivity focus is supporting P&C profit, and you can see that in an improvement in the expense ratio. For the full year, they're sticking to their guidance of around 93% for the combined ratio.
Did they give any color on that 93% target?
Yeah, a bit. It assumes a sort of normal full-year cat load of about 3%. So Q1 was a bit high on that front. It also includes a contribution from runoff business, maybe 2-3%. And they noted some Q1 specific things, like getting a bigger discounting benefit early in the year and maybe being a bit more cautious when setting initial loss picks for the year.
What about the underlying claims trend, the attritional loss ratio?
They flagged a 30 basis point improvement there year on year on an undiscounted basis. That's good news. And that's despite some noise from things like the Arch deal and moving some health business around. The takeaway seems to be retail is seeing the benefit of past price hikes flow through, while commercial's underlying profit is stable, but the Q1 reported result was hit by cats and discounting.
Okay, that covers P&C pretty well. Let's shift over to life and health. How did that look?
They call it excellent across the board, put it down to customer focus and disciplined underwriting.
Any key highlights?
Yeah, new business production continues to be really strong. Sales volume up 17% compared to last year.
Wow, 17%. Profitable growth.
Seems so. They hit a healthy new business margin of 5.5%. So volume plus margin drove new business profit up 14%.
And is this sustainable?
Well, they noted it builds on a strong 2024. They think it reflects good products and distribution efforts.
Yeah.
And it's globally diverse, too. Apparently, almost all their units saw new business value grow by over 20%. That's quite something.
What does all that new business mean for future profits?
It drives growth in their CSM, the contractual service margin. Remember, that's the pool of expected future profit from existing policies. Normalized CSM growth was 1.9% in Q1 alone. They said that's ahead of their yearly guidance and better than last year.
So the growing CSM will feed into earnings over time.
Exactly. It directly supports future profitability as it gets released.
And that's boosting current operating profit too.
Yep. The strong operating profit in L&H comes from earning that CSM, plus a small benefit this quarter from a portfolio transfer from P&C. They sort of framed it as, in this volatile world, people increasingly need trusted retirement and health solutions, which plays to their strengths.
Okay. Did they mention anything about investment returns impacting things?
They did touch on the expected in-force return. It was $748 million this quarter, which was actually lower than last year. The main reason? Falling interest rates. That impacts expected returns on assets backing both their VFA business, which uses market rates, and their BBA business, which uses locked-in rates. Lower rates mean lower expected future return.
What about market volatility? Does that hurt their U.S. variable annuity business?
They addressed that, said while volatility can increase hedging costs, for most of that business, they manage it within product features like adjusting the rates they credit to policyholders. There's a legacy VA block that's a bit different, but they said market moves in April didn't have a significant impact. Even stress tests apparently only show a low double-digit million euro impact. So not a huge structural issue, it seems.
You mentioned CSM growth was strong in Q1. Is that typical?
Yeah, they pointed out some seasonality. It's often higher in Q1 because some protection and health policies renew on January 1st, so you get a bump then, and the pattern might see slower growth later in the year like Q3.
One last thing on L&H. The return on equity looked lower, 14% versus 16% last year. Why was that?
Ah, right. They said the main driver there was purely that exceptional tax provision from the badge deal hitting the net income number, the numerator in the ROE calculation. They were pretty clear it doesn't reflect weaker underlying business. They're still confident in future profit, saying the new business they're writing is delivering returns well above their 15% ROE target for the segment.
Okay, good clarification. Let's move to the third pillar, asset management. How did that segment perform?
They characterized it as continuing to see a good level of profitability.
What were the flows like? Money coming in or going out?
Strong inflows. Really strong, actually. $29 billion in net inflows.
Wow. Both AGI and PMCO.
Yep, strength from both. But interestingly, overall assets under management, AUM, were stable.
How come, if inflows were strong?
Big negative currency effects. Took off $56 billion, basically offsetting the inflows and positive market movements.
Okay, and what's driving those strong inflows?
They pointed to strong relative investment performance. Their funds are doing well compared to peers, which helps them grab a high share of the money moving around in active strategies. Overall revenues for asset management were up 5%.
What about performance fees? Can be volatile, right?
Exactly. And they were low this quarter, especially at PIMCO, compared to a really high Q1 last year. But, and this is key, the underlying AUM-driven revenues, the fees they get just for managing the money, were up strongly, around 10%, and the margin on third-party assets held steady.
So the core fee business is growing nicely.
Seems that way. Operating profit for the segment was up 5%, and they pointed out that's exactly 1/4 of their full-year outlook midpoint. So a nice linear start.
Can you focus on costs here too?
Yep, continued focus on productivity. Despite those lower performance fees, which can pressure the cost-income ratio, the ratio was apparently barely impacted.
What?
Suggests good underlying cost control. They did mention a restructuring charge, but that hit below the operating profit line. And they clarified it's related to a strategic shakeup specifically at AGI, not PIMCO.
Okay, what's the plan at AGI then?
It's a reorganization aimed squarely at supporting their growth strategy. They talked about optimizing how they handle public markets, setting up a new structure for private markets to offer more there, stopping certain activities. Unfortunately, that includes some job redundancies. But the goal is streamlining, better service, more efficiency, ultimately supporting growth, and the bottom line for AGI.
And any very recent updates on flows, like into Q2?
Yeah, they gave a quick comment on quarter to date, so covering parts of April and May, said they've continued to see mid-single-digit net inflows, even with the market choppiness we saw, particularly in April.
Okay, let's tie this back to the big picture. Financial strength, solvency, resilience. You said solvency was stable at 208%.
Right, almost unchanged from year-end.
Despite paying dividends and buying back shares.
Exactly. That strong operating capital generation, the 6 percentage points post-tax, fully covered the dividend accrual and the buyback. Interestingly, market movements in Q1 ended up being pretty much neutral for solvency overall. Things like FX, rate volatility, credit spreads moving negatively were offset by positives from general interest rate levels and European stocks.
So that 6 points of OCG is really the key. Where did that come from mainly?
Driven heavily by those high operating earnings, especially from P&C. And there are also some non-economic variances from life health that helped, maybe adding about 1 percentage point on an annualized basis. This performance puts them well on track for their goal of generating over 20 percentage points of OCG for the full year. Oh, and the Sconet deal, selling some old business, also gave capital a small boost.
And does the balance sheet look less risky? Sensitivity.
They highlighted that their sensitivity levels to big market shocks like interest rate spikes or equity market drops are basically unchanged. That points to structural resilience, and resilience was a big theme. They talked about proactively managing the group in these uncertain times, focusing on, financial stability, risk management, balance sheet strength, good governance.
How does that resilience play out in practice?
Well, they argued their diversified model, P&C, life, asset management, plus the strength of their brand and their, quote, management toolbox gives them strong downside protection if things get rough. But crucially, it also lets them be opportunistic. They can lean into growth areas, promote specific products, maybe take advantage if markets get dislocated.
Got it. There was some discussion on the call, wasn't there, about the 208% solvency maybe being a bit below what some analysts expected?
Yeah, they addressed that, used it to clarify how they report OCG. Their 6 percentage points is before accounting for dividends. They pointed out that using the older metric, which was after dividends, their OCG was 3 percentage points this year compared to only 1 percentage point last year. So clearly, much stronger generation.
So the miss might just be how analysts model dividends and market impacts.
That's what they suggested. Could be differences in modeling the dividend accrual, especially the buyback chunk, and how those offsetting market effects netted out. Their main message was, the underlying capital engine is running strong.
And are they actively pulling levers to boost that organic capital generation further?
Yes. They confirmed they're working on lots of things from that toolbox. Some will help this year, some will take longer, some need regulatory green lights. Hard to quantify each lever, but they explicitly said their ambition for the year is for OCG to be strictly superior to last year. So aiming higher.
Okay, let's touch on a couple other strategic points. The Vidium transaction, they're taking a 20% stake with the consortium. What's the thinking there?
It's multi-layered. First, they see it as a good investment itself, targeting double-digit returns. Second, and maybe more strategically, it's a big opportunity for their asset management arm. Vidium will manage large blocks of insurance policies, and Allianz AM can potentially manage a lot of those assets. It feeds right into their strategy of bringing life and asset management closer together.
Any other angles?
Yeah. Thirdly, they see it as helping create a big, credible player in Europe for managing these legacy backbooks. Having a player like Vidium offers flexibility to the whole market. And Vidium could become a client for Allianz in various ways, maybe even taking on some of Allianz's own legacy business down the line. They see potential for optimizing solvency and assets through this kind of structure.
Interesting. Did this lead to questions about whether Allianz is shifting its overall focus more towards life and health?
It did. But they pushed back firmly, said no. They're absolutely committed to the three pillars, P&C, L&H, and AM. They stressed life is generating good returns, they're focused on profit there, and they never really moved away from it. They see life and AM converging strategically. Plus, higher interest rates actually made L&H products potentially more attractive and flexible now. They see growth opportunities, especially in protection and health, mostly organic, maybe some small deals. It's a continuation, not a pivot, was the message.
Okay. Back to P&C quickly, AGCS pricing. You said it's softening.
Yeah, rate increases are getting smaller, especially in financial lines, cyber, property, but crucially, they say they're still generally getting adequate prices for the risk overall. It just means they have to be more selective about where they grow. They still see pockets of opportunity, maybe in liability or marine lines where the market's still adjusting, the toughest markets for pricing right now. They flagged the UK and Australia.
What about keeping existing customers? Retention.
They measure it internally, but don't publish the numbers, said it's too complex and varies too much. But they suggested you see the effects in their growth numbers. For example, lower growth in the UK might reflect them being tough on price and letting some business go, whereas higher growth in Germany might reflect specific initiatives to win and keep clients.
And how does the wider commercial business, AGCS, trade credit, mid-corp, reinsurance, handle this slowing price environment?
They emphasize the diversity here. Different parts have different cycles. AGCS feels it has adequate rates overall, so there's room for careful growth in specialty areas. Allianz Trade, credit insurance, is being cautious because of the economic outlook for its clients, but underwriting quality is strong. Midcorp varies by country. Overall, they seem comfortable with their 92% combined ratio guidance for the whole commercial segment. Careful, but on a strong path.
Any specifics on cyber insurance? Always a hot topic.
Yep. Gave some numbers. About $350 million in gross written premium for standalone cyber tech risks. They stressed a cautious approach. Small limits per risk, 10 years new, 15-year renewals, and a very conservative reinsurance setup, quota share event covers, aggregate covers, lots of protection layers.
Got it. And that P&C expense ratio improvement, 50 basis points, was that all productivity?
Not entirely. They said it included a favorable mix effect and some noise from the Arch deal, but the underlying trend from their productivity work is expected to contribute about 30 basis points of improvement for the full year.
Okay, one more technical one. There was a change in guidance for valuation results and other in P&C. Went from negative 800 million last year to positive 500, 600 million guidance now. Big swing.
Right. Main reason. They reclassified some VFA business, that variable fee stuff, out of P&C and into life health, so that piece is just gone from the P&C result. There were some other minor impacts like FX, offset by interest income, but the reclassification is the big driver, making that line look much better for P&C going forward.
Last point, U.S. asset exposure. Are they heavily exposed beyond matching their insurance liabilities?
They said portfolios are very diversified, with a structured approach to match assets and liabilities. Listed equity is hedged. Alternatives in P&C are mostly hedged, except for private equity. They don't hedge the PE, economically argue it's too costly versus the benefit, but the exposure is small, only about 1% of P&C assets. They see that as acceptable risk return. The main focus for hedging is protecting the overall balance sheet resilience.
Okay, great detail. So pulling it all together, thinking like an investor, what's the context here?
Well, the really strong start, those record numbers, they signal clear momentum across the whole group. It definitely reinforces confidence that they can hit those future targets they've set out.
And you really see it coming from all the core engines, right? The P&C underwriting, the life and health value growth, the asset management inflows.
Exactly. Those segment performances are what's driving that overall operating profit strength.
And those strategic moves, like Vidium, seem important beyond just the immediate financials.
I think so. It's not just about the IRR on the investment. It's about enabling synergies, that life AM convergence, and positioning themselves smartly for big industry trends, like how these legacy insurance books get managed in Europe.
And that constant talk about resilience and diversification, it seems to be working.
It appears so. It helps them navigate the bumpy macro environment while still being able to look for and fund opportunities. They're not just playing defense.
And the communication seems pretty consistent, even when explaining numbers like the solvency ratio versus maybe what some expected.
Yeah, the focus stays firmly on executing those core capital markets day goals.
Yeah.
Organic growth, better capital generation, productivity. That message is consistent.
All right. That brings us to the part of the show where we absolutely definitely state this is not financial advice. Purely for entertainment, sparking ideas. Think of this as our wild but maybe plausible trade pitch, straight from the hypothetical hedge fund analyst corner.
Okay, let's hear it. Based on everything we've discussed, Allianz's strength, capital, strategic moves.
Here's the thought, playing directly off that Vidium insight and the whole legacy backbook theme in Europe. The idea, go long Allianz. Why? They seem positioned to benefit from this trend, both through the Vidium stake itself and the chance for their AM arm to manage assets flowing into it.
Okay, long Allianz and the other side of the trade.
The other side. Consider a short position on a different publicly traded European insurer. Specifically, one perceived to have a large, maybe inefficiently run legacy life backbook sitting on its books.
The rationale being?
The rationale is Allianz is positioning itself on the solution side of this industry shift. Companies with the problematic legacy books might face pressure from regulators, analysts, whoever.
Or they might need to pay up to offload them, hitting profits, or even become targets for consolidators like Vidium.
So it's basically betting on a long-term structural trend in European insurance, with Allianz looking like it's on the strategically advantageous side.
A classic long-short pair trade based on perceived strategic positioning. Definitely a thought exercise, as you said, requires a lot more homework than just listening to us.
Absolutely. Purely hypothetical.
Yeah.
Okay, let's wrap this deep dive up. The main takeaway from Allianz is Q1. It was straightforwardly very strong. Record numbers in key areas. Shows solid execution, keeps them firmly on track for their full year and medium-term goals.
Yep, they're clearly focused on delivering what they promised. Higher organic growth, better capital generation, and making the business more efficient across the board.
And that message of structural resilience, being able to navigate choppiness while still finding opportunities, that came through loud and clear.
Indeed. And just one final time, this breakdown was for informational purposes only, definitely not financial advice.
We hope this deep dive into the Allianz Group's Q1 2025 was useful. Let us know your thoughts.